Hello and welcome to Portfolio Matters Weekly Update Week 38. And Richard is away, so Stuart Owen has once again very kindly stepped into the breach. And before we get going, Stuart will read the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. The views of any guests we may have on the show are entirely their own, may not be representative of the views of Portfolio Matters. A full disclaimer can be found at the end.
Thank you, Stuart. Well, it's another packed week, I'm afraid. The Chinese have a curse. May you live in interesting times. And we are seeing essentially an unfolding energy crisis in the UK and Europe. And also there was the Evergrande default occurring in China, which have added to volatility this week. But before we get going, a reminder to the audience that we will be in the pub this week. On the Wednesday, the 29th, we will be in the Princess Louise pub in High Holborn. Stuart, Richard and I and a host of assorted crew will be there, and it would be lovely to see you. We have had a few acceptances now, so it promises to be a fun evening. Okay, this week's economic data. Well, we had the Fed meeting and the Bank of England meeting, and they were strangely similar. So in both cases, rates unchanged, QE unchanged. Now, the Fed talking about the end of tapering. And so it was talking about beginning tapering later this year, and the markets are penciling in November now, and they're expecting QE to have been completely phased out by mid-2022. But the Fed stated that they would not raise rates until the end of tapering. So you're not seeing any rate rises until at least mid next year. The Bank of England talked about raising rates in 2022 and a modest tightening of policy over the next few years. And as you will see, that modest tightening of policy over the next few years will have to counteract inflation, which is well above target. We'll go through some numbers. Okay, so data out this week. So we had EU inflation, and that came in at 3% in August, which was on expectation, but well above July. Core inflation was 1.6%, which again met expectations, but in both cases, those are big rises on July numbers. EU consumer confidence came in at -4, and we will show you a chart of EU consumer confidence, and it's always terrible, and -4 actually looks like a good number. Now, there were various flash PMIs for September, and bearing in mind we're still in September, have come out this week. So EU manufacturing was 58.7, which was down on August and down on consensus, but remember, we're seeing enormous supply chain disruptions and a big spike in energy prices. So actually, I find those numbers surprisingly strong and quite reassuring. The services PMI in Europe was 56.3. So again, expansionary, a decent expansionary number, though down on expectations and down on August. The composite was 56.1, again, missing expectations. Moving to the US, the US Michigan consumer inflation expectations for the coming year has risen again to 4.7%, well above the Fed's 2% target. And that is really important, because if workers start fearing inflation and demanding inflationary wage rises, you will get a wage price spiral, which is everything that investors should fear, frankly. US Michigan Consumer Sentiment Index was at 71, which was slightly up on August, but that is a very disappointing number, and consumer sentiment is back down at its lows of the COVID crisis. August US housing starts came in at 1.615 million, which was up on July and beat expectations. So that is good news. So the fall in lumber prices has meant that US house builders have got back to work. And the number of building permits also rose on the month. So all that is very positive. Remember that moving house and building are very important drivers of demand, because when people move into a new house, they buy new furniture, etc., etc. In the US, the manufacturing flash PMI was 60.5, again, solid. The services PMI was 54.4, which was down on August, but beat expectations. And the composite beat expectations. It was 55.5. In the UK, manufacturing PMI was 56.3, which was well down on August and well down on expectations. But as we've seen, there's a lot of supply chain disruption, and we have this developing supply crunch. So it's unsurprising that the PMIs have fallen, and I actually think the 56.3 is a pretty strong number in the circumstances. UK services PMI was 54.6, which was only slightly down on August and only slightly below expectations. And the composite was at 54.1. Okay, going through some charts.
So this is euro area inflation. So under a year ago, there was deflation in Europe. So a CPI of under zero. That's now plus 3% and showing no signs of reverting. I'd also be interested if we checked one day on the differences between the different euro countries to see if there's any sort of divergence there, any persistent divergence, which could reintroduce various euro tensions.
Yes, good point.
That was the headline inflation. Core inflation also rising strongly to just about 1.6%, the highest for a couple of years.
And I would add that the current energy squeeze, so you're going to see, as we go through the charts, an enormous spike in electricity prices that is going to feed through in coming months.
And here's the University of Michigan Consumer Sentiment Index, which you can see is still nicely positive, but much less so than earlier in the year, coming in around 70, whereas a few months ago it was touching 90. So a little bit here and there.
Actually, it's right down at the depths of the COVID crisis.
Housing starts, you can see a very strong uptrend here. This is, I think, actually quite impressive given what's happened to housing prices, which I thought was going to lead to people backing off from buying housing. But the numbers on housing starts are very strong. And this euro area consumer confidence, as Keith was saying, it's never above zero. So a reading of -4 is actually very cheerful. Composite PMI rolling over a bit here after picking up a lot during the summer. So still expansionary, but less so than previously. And the euro composite here showing actually a similar picture of expansion, but less strong than previously. And the US composite PMI, after reaching unprecedented levels of +70, is now more like +55. So again, solid expansion, but not the bounce back levels that seen earlier this year. And initial jobless claims have picked up slightly, but still reassuringly low levels. So the employment picture looking pretty good.
Okay, now, thank you, Stuart. We did a special podcast on the UK gas crunch. And since then, I've looked further at UK gas imports. And it turns out that we have become increasingly reliant on imports. So the light blue line is UK gas imports, and the dark blue line is domestic production. And the production has been drifting steadily lower, but imports have shot up, and we now import twice as much gas as we produce domestically. So 2/3 of our natural gas consumption is imported. And total consumption of gas was up 8.1% year on year. So despite the green energy transition, we've actually used a lot more gas this year. And where do we get it from? Well, actually, only about 8% of the UK's gas comes from Russia, because we are at the end of the pipeline through Europe, and most of the Russian gas gets used in Europe. Where we get our gas from is Norway, it's the dark blue area of the bar, and from LNG. And the other pipeline is from Holland, and that will include some Russian gas. And now, if we look at some statistics from the government, you will see that in Q1 2021, our indigenous production fell by 13% year on year, and imports rose by 36%. And we now import almost precisely double the amount of gas that we produce domestically. But in Q2, the situation got very much worse. If you look at bottom left, you'll see that in Q2, year on year, domestic production fell 40%. Now, a lot of that is to do with care and maintenance going on in the North Sea, and some of that will reverse. But the picture is of declining domestic production and increasing imports.
The UK used to have a very large gas storage facility owned by Centrica. It's a hole in the middle of the North Sea. It was called the Rough Storage Facility, and Centrica closed it in 2017. Now, it was really because it just was not economic. The operating costs and the renewal capex were never going to be recovered from the occasional use of the facility, achieving the high prices that would result from occasional supply shortages and price spikes. And it simply wasn't economic from a private company perspective. Now, if that had been a government asset, as it had been in the 70s, in effect, then perhaps a government approach would have been a more strategic approach, thinking about resilience. But as a private company, Centrica couldn't really justify that. Absolutely. And the other aspect here is that really there was a sort of ESG pressure. Why invest in an obviously declining asset, which was going to be a stranded asset? So again, a private company can't really take that perspective.
I think that is the main point, that we have made the decision to leave this to private markets, the supply of gas to private markets, and to essentially buy our natural gas, and we require now 2/3 imports on the spot market. And so we are very exposed to the international market when there is a price squeeze, and we have no strategic supply storage of natural gas in which we can draw on when external prices spike. And that's exactly what's happening now.
Yeah, an efficient market is a fragile market in a sense.
Yeah. Now, in the long term, you can see that UK's gas consumption is in decline. But as we increase our dependence on renewables, so we are relying on gas-fired power stations to provide base load electricity when the wind doesn't blow. And so, although we are using less gas than we used to, it is arguably more critical. And we're now going to do a quick calculation, because we know that Equinor, the big Norwegian gas producer, has upped its gas production. And we also know that there are 4 UK North Sea gas fields coming on stream later in 2021. So the question is, will it make any difference? So European gas consumption peaks at about 2 billion cubic meters per day. And the UK's peaks at about 280 million cubic meters a day. And those numbers are from Ofgem. And Equinor have announced an increase in 2 billion cubic meters per annum. That's 5.5 million cubic meters a day. And also we know that coming online later in the year, hopefully, is the Tolmount field owned by Harbour Energy. And that will add around 4.6 million cubic meters a day. And Blythe and Elwood, both owned by Independent Oil and Gas, they will produce about 1.4 million cubic meters a day. And Columbus, which is owned by Serica, and that's 70% gas, and that will add about 0.8 cubic meters million cubic meters a day. So all in all, that will add about 6.8 million cubic meters a day, or around 2.5% of peak UK demand, or 4% of average. So it will be useful, but really not enough to make much of a difference to the current gas crunch.
Is this going to get yet worse, the reliance on gas, as the base load from nuclear gradually flows out of the system as they reach the end of their lives?
Presumably, unless we invest in some more nuclear power stations, which we should do, shouldn't we?
But the lead time on that coming through is just decades.
Yeah. And a reminder, European gas supplies are very low. So that's the storage. And you'll see the red line is 2021. And the light blue bar, the stripe, is the 5-year min-max range. And we're well below the minimum in the previous 5 years. And we are currently at about 72% of capacity. And that is below that of any previous year from 2011. Now, when we did our special on the European gas crunch, we said that Bloomberg was saying that the gas crunch was caused by a lack of Russian domestic storage. So Russia was diverting export gas to its own storage to build up supplies for the Russian winter. Now, this chart rather undermines that narrative. It shows Gazprom's exports to Turkey. And you can see that its exports to Turkey have more than doubled this year. So it can export to Turkey, but it can't export to the EU, which rather suggests that Russia is playing geopolitics with European gas supplies. And I thought this was interesting because we have talked on this podcast many times about how the ESG movement has been focused on forcing oil and gas companies to reduce their supply without really talking about getting rid of the demand. And the current gas crunch is the inevitable consequence of that, whereas we're seeing reduced supply, but demands remain the same or gone up. So prices are going through the roof. Now, the FT have started talking about it. Is that the beginning of a change in the narrative? This is the price of electricity in France today. And it is the 1-year forward price for base load French electricity. And the chart for Germany would be exactly the same. You're seeing this spike is continuing, and that is despite the wind blowing again. So this is the UK national grid at 4 p.m. today on Friday, the 24th of September. And you'll see that 47.4% of the UK's electricity is from renewables as of now, but still 1-year forward electricity prices across the continent are not coming down. Okay, and you will be aware that various UK utilities who supply gas to households have folded in the last few weeks because of the spike in wholesale electricity and gas prices. And all these charts are from John Kemp at Reuters, who provides a free daily energy email, which you can subscribe to for free if you're interested, and we'll provide a link. Now, this shows the average UK energy bill. And you can see that of a total bill of £1,200, only about £410 is wholesale energy costs, about 35% of the total. The rest is distribution, tax, admin, etc. And if we break that down further, you can see there's this environmental and social obligations bill, which actually is tax. And a lot of that is to incentivize and subsidize the green energy transition. Stuart, you had something to say on this.
Yes, it's not a huge point, but just to say that quite a few of the green energy income funds that I've invested in have benefited from this, and they're still obviously available. They're quoted stocks, anyone can buy them, because, for instance, a wind or solar farm will be getting about 60% of their revenues from things called renewable obligation certificates. So on a standalone basis, the wind and solar farms would never be able to operate. At least they wouldn't have been able to be initiated and grow. So, as I say, a bit over half of their revenues come from these ROCs, as they're called, and that's what's composed in that grey bar on your chart.
Very interesting. Do you know why the environmental and social obligations have essentially doubled in 5 years?
Two reasons. One, they are RPI linked, which is very attractive from an investor point of view, but also the sheer number of wind farms and solar farms. Now, I don't think the ROCs are all of that grey bar, but they're a big chunk there.
Great. Thank you, Stuart. And the problem for the UK utilities is that none of them were making money even before this gas crunch. And so you'll see these are the pre-tax profit margins of the major UK domestic energy suppliers. And you can see only British Gas, which is regarded as expensive and has been hemorrhaging consumers, makes any money. All the others lose money.
Keith, I just find this extraordinary that so many companies rushed into this market. It was very thin margins. What was the attraction? I mean, who was backing it, and what was the business case? The unit economics always looked absolutely awful, and I'm just flabbergasted that the business models didn't require them to be hedged on the energy cost itself. But there you go, 70 different intermediaries pitching energy packages to people. Yes,
and I have to say I'm on Bulb, which is in trouble, and it lost 63 million last year. Now, actually, when we talk about why didn't they hedge, well, the yellow line is Ofgem's price cap. So it's the maximum you can charge consumers, and the white line is the average standard variable tariff. So essentially, the two are the same. So utilities have been trying to charge the maximum they're allowed, but they've been unable to make a decent profit on their standard variable rate. So that leads to the question, were they not hedging because they were gambling, hoping that electricity prices would fall, and therefore that would bail them out and allow them to make some money? And if they were doing that, well, the gamble completely failed. So the yellow line is consumer energy bills, and the white line is wholesale gas prices. And so you'll see currently you can't profitably supply consumers with their energy. Everyone will be losing money unless they've hedged. So expect a lot more UK domestic energy suppliers to consumers to go bust. And the current energy squeeze is also very bad for inequality. And this is, again, a very interesting chart from John Kemp at Reuters. And on the x-axis, you have consumer disposable income by decile. So each dot is a decile. So the far right one is the average income of the top 10% of households. And on the y-axis is annual spending on gas, electricity. And you'll see the rich don't spend much more on gas and electricity than the poor do. In fact, the bottom decile spend more than the next 8 deciles. So this gas crunch is going to hurt the poorest members of society. And I thought this was an interesting American take on our current British predicament. A summary of the UK energy situation. UK shuts down coal. UK tries to replace it with renewables, but fails. UK is now reliant on natural gas, but completely ignored energy security. UK susceptible to price volatility. UK gets slaughtered. I think it's difficult to disagree with that, frankly. And what has really struck me about the current debate in the UK about the energy crisis is how it has all been about alleviating the symptoms rather than tackling the underlying cause. And if we don't tackle the underlying cause, then this crisis is likely to recur. Stuart, your charts.
Thank you, Keith. Right, a bit more on everyone's favourite topic, inflation, and the US situation in particular. Now, the table in this chart shows the composition of different CPI measures. And what I wanted to draw people's attention to is that the huge weighting that goes towards housing. In the unadjusted CPI, housing represents 42% of the index. And in the PCE measures that the Fed looks at, it's between 27 and 33%. Now, within that, what is vitally important to remember is that the housing inflation that is being measured is not the price of houses, it's rent. And now you might think, well, rent is easy to assess, but the important thing here is a category called the owner's equivalent rent. So you might think of a normal rented property, and you could just measure the rent of that. But most of the housing stock is owner occupied. So what is measured is a survey of homeowners asking them what their house would rent for. Now, I don't know about you, Keith, but I might have a vague idea, but it's not going to be particularly accurate. It's going to be slow, it's going to be lagging, it's going to be error prone. Now, the reason that it's measured in this way is because when it was measured straight as housing prices themselves in the 70s, that was causing, in a sense, equal and opposite problems, because you were in effect measuring an investment inflation rather than a consumer inflation.
Gotcha.
And that's what the CPI was trying to get at, consumer inflation. So if you flick to the next slide, Keith, when owner's equivalent rent and house prices are moving roughly in line, it doesn't make any difference. But when housing inflation, looking at housing as an asset, vastly exceeds the rental level, i.e. when yields on properties go down, then you're going to get a vastly different experience when you're trying to measure housing inflation about whether you're looking at the house price or about the rent that house would achieve. So in particular, we can see a couple of periods here, including currently, when house price inflation is vastly exceeding rental inflation. Now that was owner's equivalent rent. As I say, it's a survey. Can you imagine being called up, being asked, what your house would rent for? But there's also an issue in the more normal category of just rent. And here we can see the Zillow rent index versus the CPI equivalent of what the CPI measure thinks that rent is. So the blue line here, you can see rents have been going up in the real world, which is what Zillow measure, but within the CPI, its rent is still going up apparently by only 2% a year rather than the 6% that Zillow are measuring. Now, there could well be some lagging going on here, but what that will mean is that there's like a following wind to the CPI rental measure over the next couple of years.
Thanks, Stuart. That's really interesting because actually we've talked about this before on the weekly and how Nordea have been predicting precisely this for Q4. But this is the best chart I've seen on it.
Turning to other charts, I had the impression that there was a bit of a slowdown going on in the States. So I've been having a look at some data for this. And this is a nowcast for the US economy, where actually after a period of weakness in August, the nowcast has actually bounced very strongly. So 6% annualized growth, according to this nowcast, which tries to forecast GDP growth from very high frequency short-term measures.
Interesting.
And turning to a more holistic approach to looking at turning points in the economy, I was having a look at the OECD leading economic indicators. So this is where the OECD looks at various measures to predict turning points in the economy. So for the US, for instance, they're looking at components to create a leading indicator, such as work started on dwellings, which is something we had a chart on previously, looking strong, durable goods orders, share prices, consumer and industrial confidence, hours worked, and interest rate spreads. Now, when you aggregate these up, things are actually looking very positive, and not just for the States, but for Australia, Japan, the UK. So, if you try to trust the stats rather than the headlines, things are looking very positive indeed.
So these figures go to the end of August, Stuart?
They do, yes. So they're not as frequently updated as the nowcasts. So these are a more traditional economic measure.
Yeah, because that's really interesting. But I notice that the China line has not turned down. And we have seen lots of other stuff saying that China has turned down actually quite sharply. So
true, yeah.
Something to be aware of.
We focused a lot on some of the US numbers, in particular the US labour force participation, which hadn't bounced back to pre-COVID levels. So I thought I'd have a quick look at the UK labour force situation. And it's a very similar picture where prior to the pandemic, it was about 76.5% employment rate in the UK, which fell to about 74.5%. It's been picking back up, but is no way back to the previous pre-pandemic levels. Obviously, with the end of furlough, that may change over the next few months. Flipping things around, looking not just at the employment rate, but the unemployment rate.
That's right.
You can see that has been ticking down, but courtesy of the government's job support programs, there wasn't really a massive increase in unemployment. People were being paid to stay connected to their employers. So unemployment reached only 5% and is now dribbling back down, fortunately. I think Keith will like this chart, given his previous comments on the show. Average weekly earnings growth in the UK has been very strong indeed, with bonuses and earnings growth of 8.3% on the year, without bonuses of 6.8%. So this is all grist to the inflation mill. Yeah.
We actually did feature those figures last week, but they're worth repeating, frankly. This is, how a wage price spiral gets started.
Now, the elephant in the room, it seems to me, is the global debt levels, and some recent data from the Institute of International Finance on debt reinforces just, how much more debt is being laid on year after year after year. We can see in 2020, global debt levels were about 260 to 270 trillion. And after the pandemic, we're now touching 300 trillion. It's fallen slightly as a share of GDP, but we're still talking 3.5 times global GDP. So I don't know if you remember, but a couple of crises ago, there was a fabulous book produced called "This Time It's Different," talking about the rates of increase in debt being prefigures of financial crisis. Well, it does rather look like that at the aggregate global level. Right, the UK housing market, I continue to be flabbergasted. We are turning Japanese. I think a month or two ago, I was astounded to see a 1% mortgage rate in the UK. Well, that has now been beaten, 0.79% from a company called Platform that's part of the co-op. Now, I think the interesting thing here is this isn't just a function of the low interest rates that we've had for years now. This is actually a function of the law of unintended consequences. A few years ago, the government wanted to separate out what they called casino banking from regular commercial banking and ring-fence deposits so that they weren't used in the investment banking. But what that has led to is, frankly, a surfeit of deposits within commercial banks. They can't lend. There are not enough what you would call sort of regular industrial projects to lend to, so that the money is sat there earning nothing. So there's an incentive to chase the mortgage market. So these very low mortgage rates are only on offer for very low loan-to-value mortgages, typically say under 60% loan-to-value. But instead of making the financial system safer, as the regulatory change was intended to do, in effect, it's pouring fuel on the fire of the housing market and adding to an instability risk there. Right, so low rates, of course, encourage people to think that housing is more affordable if they're just looking at their monthly outgoings. And this is a point Keith made a couple of programs ago about the sort of Minsky moment of UK housing, where all of one's monthly repayments are just eventually going to go for the capital repayment. But anyhow, the broader point is that low rates are pushing up house prices. And here's some data from Nationwide Building Society, looking in effect at the UK housing market PE ratio. One can see, like in London, the average house price compared to the average earnings in London has reached 10, where when we were growing up, it was trading between 2 and 6, and now is 10. And at the UK-wide level, the PE, having been as low as 2, is now reached a record high of 6. Mm. So just illustrating how stretched valuations are.
Absolutely. And as interest rates rise, and they are rising, that means that mortgage rates will have to rise with them, and that will put pressure on the housing market.
Another cut at the rental and residential market. I've been looking at global rental yields just to see what looked expensive. And I was looking at this before Evergrande, and the data here from Savills, looking at rental yields across global cities, was showing almost every city in China as very, very expensive, alongside Sydney and Los Angeles. And if you want to look for somewhere cheap in the world or somewhere offering a high rental yield, it's Moscow, Dubai, or Cape Town. But again, I was interested to see that Tokyo is now looking actually reasonably good value, which again is a bit of a shock, for people of our age, having grown up thinking of Japan as ridiculously expensive. You can buy a property in Tokyo and earn a rental yield of a bit over 3%.
Mm. Now, I was reminded that the land underneath the Imperial Palace in Tokyo used to be worth the whole of California at one stage, but also that if you dropped 100 yen note on the pavement in Tokyo, the value of the land underneath the note was worth more than the note itself.
Fantastic.
Yeah. So how times have changed.
Absolutely.
Okay, thank you, Stuart. Well, my turn now. And we recently did a special on Chinese VIEs, variable interest entities, which is what you own if you buy shares listed in the West, Chinese shares listed in the West. Now, the point of that podcast was that VIEs exist to get round Chinese limitations on foreign ownership of shares in Chinese companies. And those structures have been tested in court and been found wanting. And it reminded me of this old market story. So this comes from Seth Klarman's Margin of Safety, which is a great book, and you can find PDFs of it free online, and I'd urge everyone to read it. So the story goes that when sardines disappeared from their traditional waters in Monterey, California, people started trading cans of sardines, and the price went up and up. And one day, a buyer decided that instead of just trading these sardines, he would eat one. He opened a can and he found that they'd all gone off. And another trader said to him, "You don't understand. Those aren't eating sardines, they're trading sardines." And my point about Chinese VIEs is when the price is going up, nobody cares what's in the can. Nobody cares what's in the VIE wrapper. But when the price starts coming down, suddenly, actually, it matters what you own and whether your rights are enforceable. And I would be very, very careful about owning Chinese shares via the VIEs. Okay, now this I thought was a really interesting chart, and it builds on what Stuart was saying earlier. So the blue line is deposits in the banking system, and you see they have shot up, and the red line is loans. And so the loan to deposit ratio has absolutely collapsed. Hence, one symptom being that UK banks are trying to compete for mortgages, but also this is a huge collapse in the money velocity. Now, moving on to inflation, and you'll see that inflation is picking up in the UK and Europe. And I just wanted to talk briefly about the manipulation of language by the central banks. So they are all talking about inflation being transitory. Now, transitory means a passing phase that must inevitably pass. So the phases of the moon are transitory because they are guaranteed to pass cyclically. So the central banks are saying that this phase of inflation is guaranteed to pass structurally. And I'm saying, no, that's not right. You could argue that this inflation is transient, just like a heat wave. It may be of a short period of time, but you don't know how long it's going to be. And it's probably likely to pass, but we don't know how long that will take. Or it could be persistent, frankly, given that we're already seeing wages rise. And that could be the start of a wage price spiral. And the central banks have told us they're not going to raise rates until at least the middle of next year, and they are still pumping QE into the system. And this is a reminder of the UK's Bank of England's inflation forecasts. The black line was how they were forecasting inflation in May, and the pink line is how they're forecasting in August, and the blue line is the September forecast. And you'll see they're now forecasting inflation in the UK to be above 4% and to stick around for a few quarters. And their change in monetary policy has been nada, nothing, talking about raising rates. And while we talk about inflation, a reminder that container rates continue to rise, and that is goods inflation coming down the pipe. And the chip shortage, which is a symptom of all the supply chain disruption we're seeing at the moment, continues to grow. So there is a growing gap between ordering a chip and delivery. So the supply chain disruption looks like it's going to be long lasting and is not currently coming down. And a reminder that under Donald Trump, the US Treasury built up the Treasury General account by issuing loads of bonds. And in the last few months, it hasn't been issuing any bonds and it's been running down the Treasury General account. And as soon as the Democrats and the Republicans get their act together and agree and increase the debt ceiling, a whole wall of new issuance of US Treasuries is coming. And as we've talked about in previous weeklies, how will that be funded now that foreign buyers seem to have stepped back from the US market? And we have talked a lot about inflation on this podcast, and inflation is now having negative effects. So this is buying conditions in the US for homes, vehicles, and durables. And you'll see that in the case of vehicles, we know that the price of vehicles has absolutely gone through the roof, as has homes and durables, and it's had an effect on consumer sentiment. So high prices are putting off consumers. And we've also talked about this previously. Surprises. Inflation has surprised the upside, growth has surprised to the downside. So that looks like stagflation to me. But as Stuart was talking about earlier, US labor market looks very strong. The US economy looks good. So the dark blue line is job openings, and they continue to increase, and the number of unemployed continues to decrease. So you're getting this increasing gap between number of job openings and the people looking to fill them. And that is pricing power. Labor has pricing power. And so wage inflation is a possibility, and we're seeing it already growing.
Weekly checklist for equity markets. All share up a little bit. Stocks Europe down a little bit. US down a little bit more materially. S&P down 0.6%. Nasdaq down 0.9%. Japan fell a little bit, just 0.3% over the week. But the standout number was Bitcoin, which fell 14%. And that was prior to the news that I think we're going to cover in a second about China's attitude. Pound to dollar are down by 0.8%, so $1.37 per pound at the moment.
But I'd add that these small numbers on the weekly change mask a lot of volatility, because we had a big sell-off on Evergrande on Monday, and then markets have shown extraordinary resilience. They've essentially discounted that news and have bounced right back. So the FTSE ended up on the week, essentially. And this shows movements in VIX, so which is the volatility index of the S&P 500. And you can see that from Friday's close, it leapt and then has now drifted right back down and is below last week. A reminder that if you look at the valuations of US companies, they are very stretched. And based on the current valuations, you would expect the S&P 500 to have an annual return of just 3.2% over the coming decade. That is 3.2% above in bond yields. Now, big news today was China has banned all cryptocurrency transactions. And you remember that a few weeks ago, it banned Bitcoin mining. Well, now it's banned the whole lot. And you might expect Bitcoin to have taken that very badly. Well, it did a bit, but then actually it's bounced back. So surprisingly resilient. Okay, moving on to industrial commodities. Well, it was a mixed week. Now, bearing in mind that the Evergrande default will have a big knock-on effect to commodity markets, the commodities that are exposed to property construction, then actually commodity markets have been remarkably resilient. So aluminium was up a further 2.4%, cobalt was up 3.7%, copper has been hovering around its recent levels. It was down 1.5%. chromium continued to rise, up 3.2%. And we've talked about this in previous weeks, but chromium has been rising steadily when most chromium is used in making stainless steel. And stainless steel production has been declining, and the iron ore price has been collapsing. And iron ore had another terrible week, although it's bounced off its lows. It was down 5.7%. Now, our lithium numbers we get from Trading Economics. And when I went to update them this week, the chart had completely changed. So they have backfilled their old chart. Now, last week, we had the price of lithium carbonate at 92,500 yuan per ton. They've since completely revised the historic data. And so they're now saying that last week's number was over 50% higher, and it's risen from there. And we'll show you a chart later. And it seems that the previous numbers we've been reporting on lithium were wrong. And actually lithium is in a raging bull market. So neodymium was flat. Nickel has had a great run, and it was down 1.5%. Tin continued its rise, up 6.6%. Ferrovanadium continued to follow iron lower, down 4.3%. And it was a big week in energy markets. WTI was up again, up 1.2%. Natural gas did not sell off and continued to rise. So Dutch gas futures rose 11.5% on the week. We'll show you a chart in a second. Coal just grinds higher, up 2.8%. Uranium has had an astonishing squeeze upwards and came off 3.2%. So this is crude oil. Stuart.
Right. Well, to reinforce the point that Keith has been making over the past few episodes, here's a very interesting chart from Goldman Sachs looking at CapEx in the oil sector. So the point here, of course, is that as ESG pressures on oil companies mount, they don't bother investing in further production capacity. They don't explore deep water wells, they don't expand their fracking activities, etc. So the chart here shows from a peak of $140 billion of CapEx in 2013, we're now in more like the range of 30 to 40 billion. So this is inevitably going to lead to a reduction in supply in future years. And this is back to a point Keith was making earlier, that the focus on supply is one thing in terms of achieving a greener future, but we really do need to focus on the demand side as well. It's easier to sort of bash the carbon producers than it is to tell households that they need to insulate their lofts, they need to change their cars, they need to install air source heat pumps, etc. So we're really only dealing with half of the problem, and we need a holistic plan. And that does require a focus on energy efficiency, a focus on infrastructure, and ultimately it needs politicians to make hard decisions and us as the voters to swallow it and to accept it. Here's some data about UK CO2 emissions, which sort of talks to this point. You can see here in the blue line that the absolute values of the carbon dioxide emissions from the electricity, gas, and indeed the steam sector, according to this data from the ONS, have fallen pretty substantially. On this data from 200 down to 100, so I can't quite see the units, over the past 10 years. So that's great. Manufacturing has also reduced its CO2 emissions, though some of that, of course, may be offshoring production. But in terms of the transport sector and in terms of us as households, there's been very little change. There are big decisions that we have to take and lifestyle changes we'll have to accept. And we have to be big enough to support the politicians if they can come up with a plan to genuinely affect our demand side use of energy.
Okay, now I wanted to talk about, while we're talking about oil, OPEC. Now, you will be aware that currently OPEC have spare capacity and they are completely in control of the oil market, in that they have taken barrels out of the market in order to keep the oil price up. But the narrative is that OPEC have a lot of spare capacity, and next year the oil market will actually be in surplus, and therefore there is no problem with the oil market having a similar squeeze to the natural gas market. But is all the spare capacity that OPEC claims to have really there? Now, this is all from Josh Young, and he has been making the case that Saudi Arabia in particular does not have all the spare capacity it claims. So if you look at the chart on the left, the bottom chart is Saudi Arabia's crude production, and the top chart is its oil inventories, so oil in storage in Saudi Arabia. And as you can see, the oil in storage in Saudi Arabia has been falling precipitately when production has been above 10 million barrels. Now, they are claiming that they can produce 12 million barrels a day. But why, in that case, have they been drawing down from inventories whenever they produce around 10 million barrels? So that suggests that Saudi's actual production capacity is around 10 million barrels. So Josh Young is estimating they have true capacity pumping flat out of 10.7. So that is the red line. And currently they are definitely pumping below it. So they have spare capacity, but not the 12 million they claim. And Russia, a crucial member of OPEC Plus, well, in August, its OPEC Plus production quota increased, but Russia's exports and its production actually fell. So it was unable to fulfill its quotas. And does it have the production capacity that it claims? And this is a chart from HFI Research, which shows the same thing. Essentially, Russian crude exports have actually fallen over the last 3 months when its export quotas rose. Now, Russia did idle some wells during 2020, which it can bring back online. So it does have some spare capacity, but is there all the spare capacity it claims? And as a result of this, in August, OPEC Plus intended to increase its production by 400,000 barrels a day. That was the increase in quotas. It actually managed just 150,000 barrels a day. Angola, Nigeria, and Kazakhstan all failed to produce any more. So OPEC is failing to fulfill its own supply quotas. And a reminder that currently demand exceeds supply and global inventories continue to fall. So the bottom line is that Josh Young estimates that OPEC's spare capacity may be 2 million barrels a day less than they claim, in which case the market is much tighter than some commentators seem to think, in which case we could see an oil price spike like the gas price starting from next year, perhaps. Okay, moving on to some charts. So I'm rushed through these quite quickly. Aluminium continues to rise. Cobalt is drifting slowly up. Copper seems to have found a level at about $4.2 a pound. Chromium continues its mystifying rise. Iron ore has collapsed, but has had a bit of a bounce and is now at levels not seen since the lows of the coronavirus panic. So has it found a bottom? Lithium, as we have discussed, this is a revised chart. Now, it's in a liquid market, but this new chart paints a completely different picture of the lithium market, and it shows it going through the roof. Nickel bouncing around, but a good trend. Tin shooting higher. We're seeing so many of these industrial commodities squeezing higher, and this is input price inflation. Ferrovanadium coming off with iron. The Dutch natural gas future, TTF. You know, last week we were talking about how it seemed to have peaked. Well, sadly, and this is a more granular chart, that sell-off didn't last very long. It shot back up. And UK natural gas futures, I mean, it's come off in the last few days as the winds have started blowing, but it's still at very elevated levels. And gas is the most important fuel in Europe for power generation. So coal is second, sadly, then hydro, then nuclear, and then wind and solar. They combined don't make up as much as nuclear, and they're well behind gas and coal. But Europe's domestic gas production has been in long-term decline for years now. So the UK gas production peaked in 2000. Dutch gas production peaked in 1996. Norwegian peaked in 2017. So we're increasingly dependent on foreign imports. And this chart, which is busy, and I apologize for that, but it shows how we are now having to compete with Asia for LNG imports. So the pink line at the top here is the price of LNG in Tokyo, and the blue line is the price in Holland. And you can see the two are now tightly related. So we are competing with Asia for LNG. The yellow line is Henry's Hub in America. And you can see, essentially, gas is very cheap in America, but there are not enough LNG liquefaction plants in the US to arbitrage that market. Now, a point that Stuart was making earlier is that last winter, there was an enormous spike in LNG prices in Asia caused by a cold snap, and the Asians have got their act together this year and have been buying in advance, and that is squeezing the price up. One of the causes of the tightness in the LNG market is that China has now been a big buyer of LNG and has surpassed Japan as the world's biggest importer. But next year, US natural gas supplies should increase because US shale gas drillers have increased their capex intentions, although the chart we've just seen shows that there's a big gap between US gas prices and European and Asian gas prices. So whether there is enough US gas liquefaction capacity to export US gas and reduce the supply squeeze in the rest of the world is debatable. Okay, this is coal, and coal is just going through the roof. Uranium, however, seems to have hit a short-term peak. Okay, precious metals, Stuart.
Gold down a little bit, 0.6% on the week, and silver a little worse, down 1.6%. This is very much to my chagrin. I can't believe how much they have lagged industrial metals, but there we are. Platinum up 4%, rhodium an extraordinary rise on the week of 26%, at now $14,200 an ounce. Palladium coming off a bit, now $1,988 an ounce.
Thanks, Stuart. This is gold. Obviously, rates are rising, and gold has actually failed to be a safe haven as inflation has picked up, which is disappointing. Silver the same. Platinum had a bounce. Rhodium, we talked previously about how rhodium is used in catalytic converters, and car manufacturers around the world are cutting their production on the back of chip shortages. So rhodium had a bounce this week, but is that a dead cat bounce? I would not be buying rhodium at this point. And palladium similarly had a small bounce. Okay, moving on to rates. Well, UK inflation came in hot. So the Bank of England saying that they were not going to raise rates in the near future and raising their inflation forecast did not go down well with the market. And you saw the yields on UK gilts rise during the week. So the 30-year rose by 10 basis points, although frankly, it is still an extraordinarily low 1.2% for 30 years, when the Bank of England is forecasting inflation to be 4%. CPI, not RPI, which would be even higher. And in Europe, Greek, Italian, and Spanish yields also rose, but remain subdued. Now, this is an interesting chart. It shows how direct the link is between the share prices of banks, which is the orange line, and US 10-year yields. And so if US 10-year yields rise, then bank prices rise relative to the S&P 500. So yields are rising again. It might be time to consider buying banks. Now, this is the UK 10-year gilt yield, and it is rising, and that looks like a trend developing. So has the extraordinary gap between inflation expectations and UK gilt yields, is that starting to close? I've been mystified by the fall in rates over the past 6 months. And this is the US, where there has been a similar rise in 10-year yields, but not to the same extent. And finally, on to the seasonality chart, which we are in late September, and the markets should have fallen and then not bounced back, but they bounced back. Anyway, moving on. So, Stuart, let's talk about your portfolio.
Yes, so I'm now up 9.8% for the year to date, which is a nice number, but it's a bit less than the last time I was on the show. I think I've benefited a lot this year from a lot of yield compression, you know, buying stuff on a 4.5% yield and seeing it being bid up to a 4% yield gave quite a bit of capital growth. But as we've just been covering, the rise in rates recently, I think has taken some of the steam out of that. So quite a few of my holdings have edged back a bit, added to which I'm invested in a couple of social housing trusts, which have got nice RPI-linked revenues. However, a short seller has come out and given that sector a bit of a kicking. So I've taken a bit of a loss there. I'm sticking with it, but trying to get to the bottom of the short seller's complaints. In terms of portfolio activity, I sold an asset-backed investment trust that I own. And this is where I was trying to learn the lesson from my worst trade, where I had held on to an asset-backed lender when it came out with its first downgrade and first report of a bad loan. So I thought, oh, I better learn my lesson here. So I've been paring that back. I've also sold a REIT that I've held and run quite nicely, which is producing, again, a version of social housing. It's absolutely my sort of stock, RPI-linked revenues, 4 to 5% dividend. I love it, but it was beginning to trade on too much of a premium to NAV. So the good aspect of all this is that I've been building some cash. The bad aspect is that I was buying some gold miners as a geared play on the gold price, as a sort of a hedge, which has not worked out.
Thanks, Stuart. And direct evidence that Portfolio Matters actually is useful. Stuart has changed his, has made a trade on the back of it. So, you know, we have influenced somebody. Okay, my own performance during the week. Well, I had a good week because oil stocks climbed slightly. And so that puts me on 5.9% on the year, which is underperforming Stuart, Richard, and just about everyone. But I'm clawing back some of the underperformance as oil begins to, what I hope will be a relentless rise, like gas. So during the week, I sold some BP, having read yet more about its loss-making renewables portfolio and how it was selling profitable assets to invest more into it. And that was on a very disappointing gain of just under 10%. And I bought mainly oil companies. So I bought some Hess. So Hess have enormous oil discoveries offshore Guyana. And they are saying that those are due to come into production by 2026. But I'm thinking that as they're now making quite a lot of money, they may be able to accelerate that. I also bought some i3 Energy, and I'm working on a share talk on that. That has got interesting Canadian assets that bought at rock bottom prices in 2020. And Wood Group, the engineering and energy consultancy, has been a very disappointing investment. But I think now that energy markets are turning up, that its fortunes will also turn up. So I bought more of that. And then I bought more Harbour Energy, whose share price has had a bad week on very well flagged production problems due to field maintenance, which is all due to unwind in Q4 when the Tolmount field comes online. Now, I also opened a small position in dodgy coal mining asset in Zimbabwe. Thank you to Mega Chili Sauce for recommending Contango Holdings to me. And I opened a small position. They have a metallurgical coal asset in Zimbabwe. And I realized this crosses a lot of red lines, but you know, I like it.
Only you, Keith, only you.
So this is Hess, and I'm very glad to say I bought it down here at 68, and it's already up. Actually, that's best part of 10%. Lucky me. Wood Group, which has been incredibly disappointing, and this is the long-term share price performance. So I actually bought it earlier in 2021, and I'm well down, but I've added to it now. So this is i3 Energy, and I'm going to do a share talk on this, but basically it has exploration and development assets in the North Sea, which is a struggle to get funded. But then last year, it completely transformed the company by picking up some assets out of liquidation, administration in Canada, and building a Canadian portfolio. And that looks interesting. And the share price has been grinding higher. And this is dodgy Zimbabwean asset. And we will end it there. So thank you to everyone for watching through to the end. Please can you press like and subscribe to the channel. And thank you very much to Stuart Owen for subbing in. And it is goodbye from Stuart Owen.
And goodbye from Keith Jordan. We hope to see you next week at the pub.
Yes, absolutely. 29th in the Princess Louise pub on High Holborn at 6:30. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.